Mastercard stock is down 7%, not even 7% since all-time high. Should you buy it right now? Over the past 5 years, as you can see here, it's up 70%. And it's currently on a small dip, started to recover. Should you buy it? So first of all, let's compare it to the S&P 500 because 70% is not that good. So as you can see here, the S&P is doing 87% over the same period with higher dividends paid out. Mastercard is currently paying 0.6%. This is not sure about the S&P, but I think it's well over 1% in dividends paid. So let's just say half of the amount in dividends being paid. So this is not really a dividend stock because I see this my Mastercard, this stock has become popular lately on YouTube. And today we're gonna talk about it and we're gonna analyze it and we're gonna talk about why you should definitely not be buying it right now. Anyway, yeah. So as you can see here, over the past 5 years, it is clearly underperforming the S&P in terms of raw returns. And when you combine with the on top, when you put dividends reinvested on top, it's gonna be even larger. The outperformance, the underperformance is gonna be bigger. So anytime you invest in individual stocks, you have the massive risk of underperforming the S&P 500, which is the best index, the hardest index to beat. Why? Because it just contains the highest quality stocks in the world, which are currently located in the United States, because it has all the technology companies in it, such as Nvidia. Over this period, if you didn't own Nvidia, Netflix, Meta, Google, Apple, all of these companies, you would pretty much underperform the index. So Mastercard, excellent company, very, very high quality company. Definitely you want to be owning it, but it matters a lot when you can actually buy it. You cannot just buy it right now, for example, when it's gone up already over the last few years by, I don't know, let's say 50% or so, 48%. It had a period where you could actually have bought it. So here, starting in 2020, as you can see, it's going sideways for more than a year, more than 2 years actually. This would have been, actually no, less than 2 years. Let's just say 2 years. So going sideways with a big dip here in September 2022, this would have been the period to buy it, the moment to buy it. 3 years ago, 2 years ago, not right now. So you want to buy this cheap, but it's very rare that a company like this will go down by 30% or more. So you have to look for periods of times where the price action goes sideways. What happens when the price action goes sideways in a very high quality mature company? Well, they get cheaper over time. They're gonna buy back their own shares, and you're gonna see in terms of valuation they get cheaper and cheaper and cheaper. But right now, as you can see, the price action has been going up and up and up. No point in buying it right now. Makes no sense at all. This is how you risk underperforming the market. If you compare, let's just compare again to the S&P. And I'll show you, even if you have bought it at the right time, let's just say you bought it here in September 2022. Yeah, you would have outperformed, but not by a lot, and having a lot higher risk. I mean, the swings are much bigger in the Mastercard stock compared to the, but it doesn't really matter. You're not just going to place all of your money in just one stock. Ultimately, your portfolio is going to do fine in terms of risk and volatility, especially with a stock like Mastercard, which is very huge right now, is sitting at $500 billion. So this is another aspect to it. A lot of money needs to be poured into Mastercard stock in order for this to grow. And this is not like a revolutionary kind of company that just can bring out a new product or service to the market that will just make this double over 6 months. It's just not going to happen. This is just slowly going to creep up and up and up over time. You have to know what type of company it is, in which sector, which industry, how it's going to behave, and what type of valuation you're going to be assigning to it before you buy, because right now it's sitting at a PE of 36. So very spicy, okay? Very, very highly priced. It's extremely difficult for you to make a substantial amount of return when you buy high, okay? Me, I buy low. I buy very low and I sell high. It is very difficult for you to buy here at a PE of 36. And then when are you going to sell it? Hopefully some other people are going to come and pour money into this company and make this a PE of 50, and then you're going to sell it. Or you're going to say, oh, I'm just going to invest in individual stocks and I just like Mastercard because I've seen some videos on YouTube, and I'm just gonna put a bunch of money in it, and I'm just gonna hold it for 5 years. Well, look at what can happen over 5 years. 70% up, which sure looks very great, but when you're investing in individual stocks, it's not about what type of returns you can get. Now, of course, if you lose money, you're a complete moron. You're an idiot. It's all about comparing your investments to the S&P 500, okay? Even if you invest in some other index or some other ETF, you have to take that ETF and compare it to the S&P 500 because this is the hardest index to beat, the highest returns type of index. So anything has to be compared to this. Now, of course, it would be a complete disaster to consistently underperform the S&P 500. If you have a habit to pick these kind of stocks and hold them for a very long term, then you're just going to basically not increase your money, not increase your wealth. And it would be very shameful for you to just show up like 15, 20 years later with your portfolio and it's not been going very well for you and you have pretty much nothing to show for it. So again, you have a very high risk whenever you invest in individual stocks. You need to make money, okay? You need to make a lot of money and you need to make money relatively fast, okay? What am I talking about making money? Talking about over the same period of 5 years here, you need to be making a substantial, a lot more than 87%. Substantial higher return than 87%. I would be not even satisfied with a 190% or 200%. I want more because it takes a lot of time to look for stocks and monitor stocks and build up your strategy and learn about investments and analyzing stocks and doing a lot. You have to do a lot of work in order to get a big return out of the stock market when dealing with individual stocks. So it's not like you don't work for it. It's not like, oh, I just know what to pick and I just make money. No, you need to put in a lot of work. So today we're going to be looking into Mastercard. We're going to be looking at the numbers, and of course the numbers are going to look great. This is a very mature company. This is has been founded in the 60s, in 1966, I think. So $500 billion today, already very, very mature company. This is already a problem for you if you decide to invest in this company today. Why? Well, it's just not going to move very much. I mean, $100 billion of extra investments into the stock is going to have to happen in order to move the stock price up 20%. So what are we talking about? That's a lot of money. Talking about hundreds and hundreds of billions of dollars. You need to understand the total market cap of the entire stock market of the world, which is 135 trillion right now. And you also need to know the amount of the total GDP, which is about 110 trillion, I think, or a little bit less for this year. I'm not sure, around that number. And once you have these numbers in mind, then you can work with investments. Then you can start thinking, okay, where can this go? Can I get a triple out of this? Can this become like $1.5 trillion in the next 5 years? Extremely unlikely. Extremely unlikely. Okay. And getting 300% out of a stock, or let's just say out of your portfolio in 3 years, not necessarily, not 3 years, 5 years, but not necessarily out of just one stock. You can have multiple bets that can bring you 80, 90, 100% in the course of 1.5, 2 years. And then you move from investment to investment wherever the opportunity arises. And that's how you can make 300% on your money over 5 years. But looking at this, can this realistically go to 1.5 trillion in the next 5 years? Extremely unlikely, extremely, extremely unlikely. And that would be a very stupid bet to make. And is type of bet that is just gonna blow up in your face. I mean, you're just going to be lagging behind. You're not going to do bad. You're not going to lose money on it, but you're just going to underperform massively. So it's going to hurt you in that sense. You're not going to be making any money. Anyway, let's get into it. So 500 billion dollars, forward P of 30 compared to 36. So this is growing and at a decent pace, I would say. Improves the earnings quite a bit. What am I? Let's just go to the income statement here, financials, revenue. Let's take a look at the graph. Has done basically a little bit more than a triple over the past decade, which is, I would say, a little bit better than tech stocks over the same period. Um, yeah, I have my biggest position in my portfolio here. Let's take a look on my eToro is Adobe, and Adobe has done a little bit more than 4 times the revenue in the past decade. So going from almost 6 billion to almost 24 billion. And this has dipped quite a bit from 2019 to 2020. Let's take a look by quarterly. There wasn't any type of cyclicality, just probably from the lockdowns and people spending much less during that year that it's made the stock drop in revenue. But anyway, as you can see, it doesn't have any type of cyclicality to it, but it's not extremely smooth either. But it does go consistently up over time. Net income doing about $14 billion, which is, I mean, yeah, you're going to say, wow, $14 billion, that's a lot of money. Well, compared to a market cap of $500 billion, that's not that huge of an opportunity. Back when Apple was at $500 billion like a decade ago, it was doing a lot more in net income, okay? Like, it was doing like more than 50. I wouldn't say 50, but I mean, we can check. I can pause the video and check real quick. Hold on. All right, so we are here on Apple's page on stock analysis. So net income back 10 years ago was about $45 billion, and the market cap was around 600 billion. So Apple was very undervalued back then, started buying back a lot of shares, and the market cap ballooned since then. But yeah, in terms of opportunity, as you can see here, Mastercard is no huge it's actually no opportunity. You just should put your money into the S&P 500 and forget about it. Don't even bother with a very expensive stock that is sitting around 30 PE ratio. Don't it's not going to be a big enough of a bet for you. You need to be buying very low if you want to outperform the market over time. So let's just take a look at shares outstanding over the past decade. As you can see, going down consistently over time, which is good, but is obviously is what you should be expecting from a company that's like 60 years old. Okay, so 2% over time consistently. Let's see here. Back a decade ago, it was cheaper in price in multiples. So the net income it was bringing, it was allowing the company to retract more than today. It was retracting 2.7, 3.17, and today is doing like 2%, 2.2%. So the stock price either needs to go sideways for a while and the earnings to catch up again to retract these kind of percentages that was doing back a decade ago. But yeah, 2% in dividend, not dividend, and share buybacks every year is not bad, but nothing to get excited over either. So you're buying something that is very expensive and something that returns around 2% plus the 60 basis points, like 0.6%. Let's just call it 3% at best year after year. So nothing to get excited about. Operating margins. So the margins are very huge and look really good. I mean, operating margins over 50% consistently and going slightly up over time, which is great to see. So when you take a look at this company, you just say, I want to own this. In terms of margins, this company is excellent. Profit margins consistently over 40s. Free cash flow margins going up over time over the last decade. And we're at the all-time high of 54%, which is insane, crazy. Very, very profitable company. Great company. High growth as well. Double digits, still growing at double digits, even though it's a very mature company. But again, should we buy it? That's the question. Are we going to outperform the S&P 500? So cash and equivalents, $10 billion. 10 years ago, it had almost 6. Then 2020, it was sitting around $10 billion again. Yeah, it's good to have these cash piles in reserves, but keep in mind we're talking about a company that has a $500 billion market cap. So current assets, total assets 53 billion, liabilities 45 billion. So equity is very thin for this. I mean, $8 billion in equity for a company that is 500 billion. The problem here is obviously they're not ever going to go bankrupt, but it is going to be a bit more affected by valuation changes. So in case a recession happens and then the whole stock market drops and valuations go down, then this is because it doesn't have a lot of shareholder equity. I mean, there's nothing to stop the price from falling a lot more than the broader market. So long-term debt, I don't see here any long-term debt. I mean, going up over time, 18 billion, 19 billion. It's not total debt, net cash. They have minus 8 billion. Last year they had minus 10, so paying back a little bit. Yeah, I didn't expect to see this. The margins that Mastercard has. I mean, 100% gross margins and over 50% other profitability margins. I mean, it's kind of crazy that they went into debt. I'm not sure what they needed to go into debt for. We're gonna take a look at stock-based compensation next because that's kind of weird and crazy. Why would this company need to go into debt? I mean, not go into debt, but any company uses debt, but they have net cash negative, which is not something I would like from this kind of company because it has huge margins. It just doesn't need to. So yeah, net income going up nicely over time. High growth, not exponential growth, not anything like that. Just normal high growth, as you can see. Not 45-degree angle type of growth on the graph, but I don't know, like 30-degree angle, I would say. Repurchases of common stock going up and up and up over time, which is exactly what you want to see. But as you saw before, it retracts less and less and less. Why? Well, 10 years ago, it was able to retract about 3% with about $3.5 billion. And today, they're retracting about 2% using $12 billion. Why? The price is much higher. So they have to pay a much higher price. So what does that mean? That means less returns for you as a shareholder from their net income. So you basically have to rely on the market, the other people in the market buying this stock and make the price higher for you. It's not a real return, okay? It's a speculation type of move, very speculative, and it's not a good one either because the stock is very high in terms of valuation. We're going to take a look at valuation now, at valuation ratios, PE ratio. As you can see, nothing. I mean, 2020, it got very expensive, corrected like we saw there on that period where the price action went sideways, and now we're sitting at, I don't know, average above the low on this graph, which is the last 10 years. So definitely, you should definitely not get excited for something that's not at an all-time low and also at a 36 times current level, which is kind of crazy. Forward P obviously is going to be smaller, but same type of graph here. We are not sitting at an all-time low in terms of forward P. So again, nothing to get excited. I wouldn't touch this right now. I will also give you an example when you could buy these type of huge market cap companies, because I was involved with one of them this year, and I will, towards the end of the video, I will show you an example of the type of situation where you can buy some of these type of companies. But yeah, EV to sales 15, as you can see also on this graph, 15 times right now. 10 years ago it was about 10 times. EV to EBITDA 25, which is not excessive, but it's not a very small number either, and it's not dirt cheap by any means. Return on capital invested 43%, 44%, going up since 2020, but not moving that much higher since a decade ago. Still, it's very good, and the number itself, it's huge and is extremely good. And when I see this in a company combined with the margins that we've seen, I'm gonna tell you right now, yes, I would definitely want to own this, but I cannot buy it. It's just too expensive. I have other opportunities that have same type of margins and higher returns, and I showed you earlier, Adobe. I mean, let's take a look at the ratios. ROIC going up over time, 20% right now, which is a very high number as well. Return on capital employed, 45%, going up over time. It has not stabilized yet. As here in Mastercard, as you can see, it's kind of stable, has averaged at around 50% return on capital employed over the past 10 years. So it's already a very, very mature company, and you should not be seeing a consistent growth in these type of numbers. You should just be seeing a very high number, and that's it. So yeah, this is something that I would like to own, but looking at the valuation, FCF yield, yeah, 2020 was extremely expensive, and then it corrected. Yeah, you could say it's, in terms of the free cash flow yield, sitting at the same level it used to be in 2022, but it's just 3.5%, okay? And it's not at an all-time high on this graph either over the past 10 years. But also compared to the market, it's just a little bit less expensive. But FCF yield is not everything. You have to take everything else in. PE ratio, EV to EBITDA, EV to sales, everything, and compare it to the S&P. Also compare it to the peers, to the competitors, okay? You have to take a look at Credit services, you go here. I do own a bunch of companies in here, not directly competing with Mastercard, but I do own, for example, oh, they're not here. I do own PayPal, I guess, and some of the other are missing, but they're in the same type of industry, but definitely not. I would never buy something that's extremely highly valued, no matter what the growth is. The growth can slow down, and then the price is just gonna pop in your face. I mean, if you don't think that's possible, I mean, let's take a look at something I bought recently, Fiserv. Bought it about a month ago. It completely crashed. I mean, look at this. This too was very consistent and high growth and decent margins until something happened and it started to pop, and it popped by 70% or more. Can Mastercard pop by 70% or more? Extremely unlikely, but it does happen, okay? High quality stocks can also go down by 70% or more. Facebook, Meta, not Facebook. Okay, history. We go to history here and we set the graph. Take a look at, look at this. Going from 380 down to 90, okay? That's more than 70% drop. That is huge. That is ugly, okay? That's very ugly. It's like there's no bottom to it. Okay, and Facebook also has extremely high metrics and profitability and everything. Has it recovered since? Of course. But these are the type of opportunities that you should be taking, not when it's here at the top, okay? Not when it's here at the top. I mean, what are you doing? Very small dip here compared to the S&P, and you're gonna be buying it, and you're gonna think, oh yeah, that's a very great buy, and I'm gonna massively outperform the S. No, you're not gonna be massively outperforming the S&P with these kind of buys, okay? You will just not gonna. Netflix. I mean, look at this. Falling knife. Look at this. Going from $70 down to about 16. That's the type of opportunity that I'm looking for. Very high quality companies, buying them at the low. I buy low and I sell high, okay? Fiserv, I bought low. I'm breaking even on, put 4% on it. Here's my eToro portfolio here, which you can copy. But yeah, Fiserv dropped massively in one day after dropping. I have been monitoring it, and it kept dropping and dropping and dropping. And I said, okay, this 40% drop is ridiculous. I'm just gonna be buying it. Obviously, you need to do your stock analysis, but I was ready. I already analyzed the stock for years. I had it on my radar, and that's just what you need to be doing. You need to put in a lot of hours. You need to be ready. You need to know all the stocks. You need to have your little investable universe, a list of stocks. I have about 200 stocks that I'm willing to invest in the US stock market, and this was one of them, and it dropped by a lot. So huge opportunity arose, and I bought it. Same with Adobe. I mean, look at this, 33% invested, not down by a lot. Started to buy it 6 months ago, and I kept adding and adding and adding to the position. Now we're very well positioned for next year, I would say, to look to massively outperform the S&P 500 again. This year we did about 38%. 38%. Let's see here. Can we compare it? Overview. Not sure. Yeah, I don't think we can compare it. I'm not sure why. You used to be able to compare it to the S&P 500 here. But yeah, anyway, with the risk contribution as well, if you take a look here, 6 months ago when I made some changes in my portfolio because I had Intel as my biggest position, we removed Intel because it was bringing a lot of volatility to the portfolio, and now we're at very low risk of 4. I don't even want to go lower than 4. I want to have maximum type of returns with lowest amount of risk, okay? I want to attract copiers on my eToro portfolio. I want very low risk here, very high returns. So you take a look at the portfolio page here and click on history here. You can see some of my past trades, 46% ACM research. Some big positions that I closed were in semiconductors, Intel, 75, Samsung, 75, Applied Materials, 43%. And these are companies that I bought in April and I sold after like 6 or 7 months, okay? So making 50%, 60, 75, 80% on your money in 6 or 7 months is extremely good, and you're on your way to outperforming the market. Are you going to make 40%, 50% on your money by buying Mastercard? Or are you going to be able to make 40, 50% by buying Fiserv? Okay. Fiserv needs to go from, we need to go back in the graph, back to 2018. So it just needs to go back to like, in order to make 50%, needs to go back to 102 on the graph. What is, I mean, we're talking about this company. We used to be trading at 235 in February this year, and it had a very long base where it just went sideways, hovering around 100, 110. So what are we talking about? Where do you think it's much easier to make 50% return on your money? On this company that is trading around this type of levels and has a market cap of 37 billion right now, or Mastercard, which is 500 billion, and in order to make 50% on your trade, this needs to increase by 250 billion dollars. So what are we talking about? Which do you think is more hard? Which do you think is going to be harder to do? This company, which do you think is going to make me a faster 50% return? This one or Fiserv? Even though when you look at Fiserv, yeah, it's not as high quality as Mastercard. Let's take a look at margins. Cannot even compare them. Let's take a look at margins. 60% compared to 100. Operating margin in half almost. Profit margin in half. Free cash flow margin less than half. So 20%, 29%. But it trades at a much, much cheaper multiple. It has been trading at a much cheaper multiple. And with the net income from this 29%, which is not bad, it's really good actually, they were able to retract 3.5%, 5% in 2023, 5.5% in 2024, and trailing 12 months this year, they already retracted more than 5%. Look at this. After they bought out First Data in 2020, they absorbed, and the share count reflects this. They were able to buy back their own shares at a very rapid pace and basically get down to where they were before almost. But now this is back when the stock was trading at $200, okay? This is 5% retracted when they bought back shares when the share prices were costing them 170, 180, 200 or more, okay? Well, now the market cap is $36 billion, okay? It used to be $36 billion back 6-7 years ago. What are we talking about? With the net income that they can bring each year, $3.6 billion of net income, they can retract a lot more in percentage terms. Repurchase of common stock, let's take a look at here. $5 billion in 2023, 5.8, trailing 12 months, $7 billion bought back. That's great to see. Very consistent buybacker of shares, and they're doing more and more and more. Okay, sure, they can pause this, but why would they pause doing more buybacks right now? They're not going to pause buybacks, but they can, if they have some problems with their debt, yeah, sure, they can do a bit less than 7 billion. But still, even if they do half of what they've been doing this year, which is going to be like 3.5 billion, that's like 10% of the market cap in share buybacks, which is crazy. That's going to be a very powerful force that is going to drive the price up. EV to EBITDA 7 compared to 25 in the Mastercard that we looked at. And I wanted to show you an opportunity right now. I'm going to show you where you could actually be buying a very huge market cap company and make a decent return on it. So Microsoft, as you can see, the graph doesn't go straight up. 125%, a lot better than the S&P and a lot better than Mastercard. But it had a period here that ended earlier this year where it traded sideways for a while and it dipped hard in April 2025. So I was monitoring this company just going sideways and sideways and sideways. In February, I thought, well, it passed more than a year and price action went sideways and the valuation became much, much better over time, over this time period. And then it dipped pretty hard. And this was a huge opportunity for you to buy Microsoft, because not only that it went sideways for more than a year, it also dropped in price quite a bit towards the end here, more than 10%. Used to be down 23% from the all-time high then. So here, this is the type of situation where you could be buying it. You could be buying a very large cap company. Let's take a look. Microsoft. Let's take a look at the valuation from this year and what was going on. At 2024, take a look by quarterly. Yeah, March, it got down to about 28%, and this was the period that I was talking about. So yeah, these kind of dips are very small, so you're not working with huge opportunities. But if you wanted to buy a very large cap company, you have to have some type of correction through time, like look at 1 year at least, where the price action goes sideways, or some type of combination where the price has been going sideways for a while and then it dips a little bit, but not here, okay? Not here. There is no opportunity here. There's no it's just it went up 17% since 2024, March of 2024 until end of this year. It's just I don't see any huge opportunity. But yeah, anyway, that was about it. A long video, but hopefully it's gonna wake you up a little bit.